Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1533 and today's date is March 31st, 2018, and the title of the episode is Liquidity Crisis Headed Our Way. The economic warning signs are everywhere. Now, before I get started, I just want to make an announcement. I uploaded an interview with London Paul. It is on the X22 Report Spotlight YouTube channel. So all you need to do is go over to YouTube and type in X22 Report Spotlight. It'll bring you right to the interview. Or you can come over to the X22Report.com site or NewsSentinel.com site. Scroll down a little bit, look over to the right-hand side, and you can play the interview right on the site. Or go to Steemit, that's steemit.com/@X22Report, and you can play the interview right on Steemit. Let's get into the economic collapse financial news. Now, we talked about the liquidity crisis that is occurring in Europe, where there's a shortage of dollars. And this is going to continue. But what's very interesting is that here in the United States, there is a paper that came out that was just released by the Brookings Institution. And this has to do with the looming mortgage liquidity crisis. Now, when they looked at this, they saw that non-bank mortgage companies are vulnerable to liquidity pressures in both their loan origination and servicing activities. Now, what they're saying is that there's about almost two-thirds of Ginnie Mae guaranteed securities, which are issued by independent mortgage banks. And these independent mortgage bankers are using some of the same tricks that they used in the past. And this is going to be a problem as we move forward. Now, what they're saying is that we've been very lucky up to this point. Why? Because the economy, well, it hasn't fallen into a recession. And mortgage delinquencies, they haven't increased the way they have in 2008, but they are moving up. Now, the thing is, we are in a recession. Even though they manipulate all these numbers and the government didn't come out and tell us that we're in a recession, doesn't mean we're not in a recession, because what they normally do is they go back in time and they tell you, oh, this is when it really started. The same thing's going to happen this time. So what this really means is we're in a lot of trouble right now. Now, non-bank mortgage providers essentially borrow short and lend long, using warehouse lines of credit from banks to fund mortgages. From 2012 to the third quarter of 2017, commitments on warehouse lines has increased 70%. Of course, if it all goes well, a mortgage will be sold quickly into the secondary market and the line will be reduced. Now, if things don't go well, like they did in 2008, we're in trouble. What can go wrong? Well, the Brookings authors identified three vulnerabilities in the process. Number one, margin calls due to aging risk. Example, the time it takes the non-bank to sell the loans to a mortgage investor and repurchase the collateral, and or mark-to-market devaluations. Number two, rollover risk. Number three, covenant violations leading to cancellations of the lines. Now, these vulnerabilities are very real. Should there be a sudden increase in interest rates or other significant change in the market, well, that means that the collateral values will drop. That means we will be in trouble. Now, mortgage servicers have liquidity issues because they're required to continue making payments to investors, tax authorities, and insurers if mortgage borrowers quit making payments. So they still have to make payments. And we can see that once this system crashes and the clock is ticking, well, we're going to have a major problem in this area. And it's looming. It's right on the horizon here. Just like liquidity crisis in Europe. I mean, think about what's happening here. We're seeing indicator after indicator showing that if there's one little hiccup, all of this completely comes down. Now, what else are we seeing? Well, it looks like we have a problem in the subprime market once again. Now, the Financial Times, they're reporting that not only are subprime mortgage-backed securities becoming prominent again, but that the chase for yield was what is fueling the demand. And it's like deja vu all over again. Because what we're seeing is that mortgage originators, real estate investors, they're doing the same exact thing that they were doing in 2006, 2007. And what we're seeing is that mortgage levels are already almost back to 2008 levels. But don't worry, the S&P says the risk is completely contained, which we know it's not. It never is. And we see that the Federal Reserve there's nothing that they can do at this point. They have already created the stimulus. They've already created the currency. They've created all of this. And when it comes crashing down, it's going to be a complete and utter disaster. We're looking at every single indicator right now, and every single indicator is pointing to a recession. We're not looking at the economy saying, wow, this looks like growth. This looks like it's improving. The indicators are not pointing to that. The indicators are pointing to that we have a major problem in the economy. And of course, when it all falls apart, that's when everyone starts to realize what has really happened here. Yes, they have the ability, and they're very good at it, where they can keep the illusion alive up to the point where they don't need to keep it alive anymore. Just like prior to 2008, all throughout that year when they were going in to save Bear Stearns, when they were putting out this fire, putting out that fire, telling you that this is contained, telling you that there was no recession, the market's not going to crash, and the whole thing came down. In the same year, they were telling us that everything was fine. The same thing's happening right now. But now, they're just keeping the illusion completely hidden from the public. And when it all comes down, they're going to be pointing the finger someplace else. When I say they, it's the central bank. They never want to be blamed for what happens in the economy. They always blame some other entity of why this happened. They come up with this other story like, oh, it wasn't our fault. It was because of this, that, and the other thing. Now we see that China, they are definitely pushing their agenda with the petro-yuan. Now, just days after Beijing officially launched the yuan-denominated crude oil futures, and that seems to it's going pretty darn well here, it looks like they're taking the next step. A pilot program for yuan payment could be launched as soon as the second half of the year, and regulators have already asked some financial institutions to prepare for pricing crude imports in the yuan. Now, according to the proposed plan, Beijing would start with purchases from Russia and Angola, two nations which, like China, are keen to break the dollar's global dominance. There are also two of the top suppliers of crude oil to China, along with Saudi Arabia. It's very interesting. Saudi Arabia will be next. And we're waiting for that signal where Saudi Arabia says, okay, we're going to start selling part of our oil in the petro-yuan. Once you start to hear this, it is game over. Now, there's going to be a change in the default crude oil transactional currency, which for decades has been the petrodollar. And if there's a shift in just a small part of the global oil trade into the yuan, well, this is going to be huge, because oil is the world's most traded commodity, with an annual trade value of around 14 trillion, roughly equivalent to China's gross domestic product. Currently, virtually all global crude oil trading is in dollars, and eventually what's going to happen is countries are going to move away from the dollar and they're going to go into the yuan. This whole thing is being pushed and pushed hard right now. And of course, the financial pundits and everyone's out there saying, no, this is not going to do anything. Just like they said, oh, China's yuan will never be a reserve currency. It'll never be added to the IMF, the SDR basket. We don't have to worry about that. And here we are today. When we look back over time, yes, it took years, but here we are today. And when we think about it, it happened very, very quickly. And all they need to do is to ramp this up very, very slowly. And what I mean by that is all they need to do is say, okay, you know what? Let's take a portion of our oil sales. Let's price it in petro-yuan. We'll still hold dollars. We'll still hold the petro-yuan now. And we'll do both. And we'll move the sliding scale over very, very slowly. We'll do a little bit more petro-yuan. We'll get a little bit more of the dollars, remove that. And before you know it, Saudi Arabia, the rest of the Middle Eastern countries, they're all using petro-yuan. And once they start to do this, this becomes a very big deal. Even in the beginning stages, it is a big deal because they don't need to keep the dollars in reserve, which means there's going to be a liquidity crisis in dollars. And that means all these dollars, well, they're going to float back to the United States, which means there's going to be a devaluation of the dollar. I mean, we've had a devaluation on the dollar, but this is going to be something like we've never seen before. It's going to be inflation, hyperinflation, and it's going to get worse as time goes on. They've already started the process. Yes, people can poo-poo this. People can say it's not that big of a deal. Just like they said it wasn't really that big of a deal if the yuan is included in the SDR basket, which is never going to happen. Well, it did happen. And here we are today where it's included. Now there's a petro yuan. Now countries are going to be trading in the petro yuan. Saudi Arabia is going to be looking at it and mostly ramping up on their reserves in the petro yuan. We're going to see other Middle Eastern countries do the same. So it is a big deal. And what happens is it creeps up on everyone very slowly. And once it gets to the point where you're at the halfway point, then everyone starts to notice and people say, what is going on here? That's what's happening now. It's been creeping up very, very slowly over a very long period of time. And what they're doing is they're preparing to shift everything. They're not going to do it like with a snap of a finger. They do it very slowly. They get everything into place. They prepare everything, make sure that everything is ready for it, the new system. And then slowly they transition while no one is figuring it out, while the financial pundits and everyone is saying it's not a big deal, don't worry about it. The U.S. is strong, the dollar is strong, we don't have anything to worry about. Well, we do have things to worry about here because this is the transition that you're watching. You're going to look back in time, and it's not going to even seem like a big amount of time because people are going to look back and say, wow, look what happened. Over the many years, the dollar kept on losing value. We've been losing out in the Middle East. We've been losing our grip. China has been building up manufacturing. All the manufacturing has been moving out of the United States out into Asia. Companies have been moving out into Asia. They have all the gold. Now they have the One Belt, One Road. It seems very similar to what the United States once had when it became the reserve currency. And now they say, well, yeah, they started the petro yuan, not a big deal. Now, they have the quarter of the market. Now they have half of the market. And before you know it, the United States loses the reserve currency. And when people describe this and they go back in time, it's going to seem like it happened very, very quickly. We're watching it real time right now. We've been watching it real time. And the situation is getting worse and worse. We're headed towards a transition. And before you know it, with a blink of an eye, it's all going to be said and done. And this is why you need to be ready and prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.